In this video, I go over my plan to recycle my money after the Fed meeting this week. If you have been letting the economy and interest rates dictate your strategy and you're not finding the success that you're hoping to find, I'm here to share how I have found massive success in just a few years. This is one of the biggest mindset shifts that people struggle with. Once you understand that to build wealth, you need a blueprint, and to stick with that blueprint, regardless of what's happening in the economy with interest rates and with stock prices, you'll find more success than you've ever found. In this video, I'm going to break down what I do and how I found that massive success so quickly. So, quick little story if you aren't familiar is back in 2022, I had a mindset shift where I found a Instagram reel from Damon from Shark Tank talking about how rich people, what they do is they buy stocks and then borrow against them to buy more. So I took the $20,000 cash I had and I bought stocks with it. Then I borrowed from my paid off car to buy more stocks because the market was declining and because interest rates were so low at the time. And then that got me quick. Then I used margin in addition to that to buy more shares, and that quickly got me up to $100,000 portfolio, way faster than it would take if I were to dollar cost average my way in the entire time. And the thing is that this is the strategy. I'll outline it a little later here, but here is an illustration of exactly what I do. So we'll look at the Nasdaq as an example, just because it's a little more volatile than the stock, like the S&P 500. Essentially, if I were starting out, the blueprint would be this. This is going to be a high, like a glazed over overview. The full blueprint is in my ebook if you'd like to check that out. So if I were to start out, I would just buy, and continue to buy. And all the way up to the top, I would buy. And then when it goes down, I would buy even more. However, and I would buy much faster. And I would buy with margin with large sums of money. To explain why, think of it like this. So if you were to dollar cost average, let's look at like 2022, for example, right up here, is you're buying all the way up and then you buy all the way down and you buy through the entire thing. And if you were to dollar cost average, imagine you can save $12,000 a year, so $1,000 a month. You would only buy $12,000 in total. In 2022, I don't remember exactly how much I bought, but in 2025, with this very steep little quick decline, I bought $100,000 in just this short little period of time. Do you think I could buy $100,000 if I was dollar cost averaging? No, I couldn't. Not a chance. I would have bought a couple thousand at most. So that's the power of this strategy is you can maximize on these downturns. And then when it comes up, you have amplified upside. Yes, if it keeps going down, you have amplified downside, which is why there's safeguards in place that I use and talk about in some of these other videos. You need to have safeguards. Margin doesn't come without risk, but I have rules in place for exactly what I do. A couple of those rules, just to touch on them quickly for you, to keep you safe if you want. And keep in mind, I'm not a financial advisor. None of this is legal advice. It's just my experience and what I've learned and that I personally use. So do your own research. But some of these rules would be I don't day trade, and I'll touch on some reasons why. I don't buy any individual stocks. Well, I have Microsoft, but I wish I didn't. But in general, I don't buy any individual stocks anymore. And the reason is that if you buy individual stocks, let's look at Tesla, for example. Yes, you can have a ton of upside. However, it's so volatile that there's times like this would get you margin called, more than likely. So that's why I don't do that. And it's possible you can get higher returns if you do that, but I'm not chasing the highest returns. I'm chasing consistency, and I am pushing for higher returns than the S&P, and I've delivered them over the last few years consistently. Let's look at like since 2022, I've got 123% gains. I don't remember where it's at. Somewhere there's like benchmarks. Perfect. So if I were to look at my benchmark compared to the S&P, let's do that here and see how I've performed, because this will give you a good idea of if this might be a good way for you to make your money compound for you. So you can see the green line is the S&P, and I am the white line there. I've outperformed it by 20% in the last, what is that, since 2022, so almost 4 years. So quite a bit in the last year. I've also outperformed it by about 10%, 9%. So this is the power of buying the entire time. On the way down, you buy with more faster, but you have to be very careful and you have to manage your risk very carefully. What I mean is, like, let's look at my margin health. I have a pretty healthy margin. I want to get that up even higher. And as the market goes back up, then I pay down that debt with income. So the income I have from, like most people, it'll be their job, things like that. That income is used to pay down the margin on the way back up. And a lot of people have asked me what I would do in these market crashes. This is it. This is what I would do. And then here's the thing is in 2000 in the dot-com bubble, like this could happen again. And this could margin call you if you're not careful. So you need to have safeguards in place and you need to be very careful if you're going to use a strategy like this. And you need to do some research. So if this were to happen though, there is a ton of potential. So yes, most people would not be very happy with like a 15-year to get back to the price you're at. But look at this. So is that like 4,700, 4,900, 4,800, whatever? It took until 2015 to get back to that 4,800. But after that, the market just roared. So had you bought that entire time, had you margined on the way down, yes, you'd be having some of that interest drag across this entire time. But as it comes back up and as you keep on buying, you would own so many shares at such a lucrative price. When it comes back up, you'd be having many millions of dollars. And this is much more tax efficient. Earlier, I talked how I would touch on day trading and why I don't do it. This is much more tax efficient than day trading. Day trading, you're constantly paying short term capital gains. You don't get any dividends. Often you miss the 10 best days in the market. And years like 2022, like the 2008, like 2000, like 1999, 2000, that type of stuff will ruin you if you're a day trader. It's easy to trade in a market like this. Almost anything you can buy is going to make you money, right? But in times like those big depressionary periods and bear markets, you're going to lose so much money and you're going to be just kicking yourself. You would wish that you were doing something different. So, yes, this is the strategy. This is how you do it. And then in a future video here, I'll give you a brief little glance at it as kind of a introduction to it, but you need to track your income and expenses. And I do this some more. I track a lot of stuff. So here I touch on this in either a future video or a past video. This is my net worth in M1 Finance only. And this is, I have the date and then I have the matching date. This is the total value of my stock portfolio. This is the debt. So that would be like this minus this is equal to my net worth. Then I have my bill over here, and then I have my dividend payments, and then I have my total dividends paid since I started this. Track my interest rate, and I track my stock portfolio's net worth. And let me see here on the screen there. Let's go back to where we just were. So this is content sheet. I'm going to dive deeper into this in the future here. It's got a lot more in depth now. So I go over like all income and expenses. But at the bottom here where we just were, I think you're going to find a lot of value here, is I track different properties. I do own some rentals. And then this shows the income for those. And then expenses, you have the cash flow, which would be your income minus your expenses. I have the loan balance where every month I track that so you can see the loan get paid down over time. I show how much the loan gets paid down over time. I have the home value estimate here. And then I have the equity, which would be the home value minus the loan balance. On the right, you can see back in 2023, this was my net worth just a few years ago. Right now, it's much closer to 800. And then you can see I was tracking my interest rate at the time. So I use M1 Finance. Robinhood's another great platform. I track my line of credit available because you obviously don't want that to get to zero. If you are doing something like this, you have to be very careful with managing your margin because your line of credit can go to zero. That actually happened to my girlfriend in 2025, and I got a little salty because I was telling her you need to be careful because the market can go down. And then I do have some money in a 401k. At the time, I was having a bunch of cash on hand, and I made a video very recently, either that, I don't know if it's coming out before or after this, but I talk about emergency funds and why you shouldn't have it. At this time, I didn't realize that, and I had an emergency fund still. I had a car loan. This was still paying it off from 2022. In the future, I used my line of credit to pay off that car loan to free up the cash flow. And then, just to give you an idea of how my mindset shifted over time, I started tracking more metrics. And again, I'm going to get deeper into this in the future here. But so now you can see my net worth has gone up a lot. And you can see that I have tracked it very diligently every single month. And I didn't start doing that until 2023. I wish I started this spreadsheet a long time ago. But as you can see up here, it gets a lot more detailed than it was down there. So looking forward to going over that with you in some future videos. And I guess to give you a brief little glance, I would recommend doing something like this as well if you are going to start out. So it's very nice to see that progress over time. Very motivating, especially a few years later when you blow up your portfolio, not in the bad way, but in the good way, where you basically, I don't know what that would be. That'd be more than 5x the amount in there. And you just get to see like that just feels so good. So looking forward to some of these future videos I'm going to be going over with you. See you next time.